Welcome to the deep dive. We take that huge pile of research, financial reports, market analysis, all that stuff, and boil it down to what you really need to know.
And today, we're diving into a company that's really more than just a retailer. It's become a bit of a cultural icon, hasn't it? Lululemon Athletica, ticker LULU.
Exactly. And it feels like the perfect moment for this deep dive. Lululemon, founded up in Vancouver, didn't just succeed in the high-end athleisure market, they arguably created it.
They absolutely did. For years, their story was all about hyper-growth, this amazing brand power. Just a premium player nobody could really touch in that space.
Which is why the current situation is so, well, fascinating. So our mission today really is twofold. First, we need to get under the hood and understand the strengths that push Lululemon past, believe it or not, $10 billion in annual revenue in fiscal 2024.
Incredible number.
Right. But second, and this is the crucial part now, we have to dig into this sudden, really sharp slowdown in their growth and figure out if their big, ambitious strategy for the future is, actually viable. They seem to be at a real crossroads.
That's a good way to put it.
Yeah.
Just to set the scene quickly, Lululemon designs, sells, distributes athletic gear, apparel, shoes now, accessories, think yoga, running, training. Traditionally, the women's side of the business has been the bedrock, still the biggest chunk of revenue.
But they've been pushing hard to diversify, haven't they? Especially into menswear. That seems like a major strategic pillar.
Huge pillar. And we've all heard of the ABC pants, right? The anti-ball crushing pants.
You gotta love that name. It tells you something about their confidence, maybe their slightly irreverent approach.
It does. And look, that focus on men's paid off, at least for a while. In fiscal 2024, men's grew 14%. Which is pretty significant because it was faster growth than the women's segment, which grew at 9%.
Okay, so men's was outpacing women's.
Yeah.
And then there's the other category, too. Accessories, footwear.
Yeah, that includes the accessories, the bags, the yoga mats, and importantly, their newer footwear line. That's been growing too.
So, okay, $10 billion company.
Yeah.
Successful diversification into men's. Amazing margins, which we'll get to. Sounds great. But the whole reason we're doing this deep dive now is because of one really jarring number.
The guidance.
The guidance. This is a company that over the last 5 years delivered something like a 25% compound annual growth rate.
Yeah.
Just phenomenal. But their forecast for fiscal 2025, they're guiding for revenue growth of just 2 to 4%.
Yeah. And that's the heart of the matter. That's the tension. Going from being this hyper-growth darling valued way up here because everyone expects massive expansion, down to projecting mid-single digits, maybe even low single digits. That's not just a blip.
No, it feels like a fundamental shift. The market has to completely reevaluate what this company is. Is the explosive growth phase in its main market just over?
That's the billion-dollar question, isn't it? Or maybe the multi-billion-dollar question, given their size. It forces a total rethink of valuation, of strategy, of risk.
Okay, so before we dissect the current slowdown, let's really understand how they got so big and dominant. What makes up Lululemon's competitive advantage? Their moat, so to speak.
Well, it's really built on, I'd say, 3 core pillars that work together. And the first one is absolutely fundamental, their direct-to-consumer model, the DTC strategy.
Right. They mostly sell through their own stores and their website. How exactly does that give them an edge, especially on profitability?
It's all about control, total control, from the design board right to the final sale. They control the brand image meticulously in their stores, that whole customer experience, and critically, they control the price.
So they don't have wholesale partners like department stores breathing down their neck demanding discounts.
Exactly. They're not relying on Macy's or Nordstrom or whoever to move product, often forcing markdowns. Lululemon can maintain that premium, full-price positioning much more consistently, and that lets them capture much, much higher gross margins than competitors who rely on wholesale.
Makes sense. They keep more of every dollar. And their online business, their e-commerce, that's not small potatoes either, is it?
Oh, far from it. It's huge. As of Q2 fiscal 2025, digital sales were, 39% of total revenue, almost 40%.
Wow.
Yeah. And it's not just about the sales volume. E-commerce is typically a high margin channel for them, too. Plus, it's this incredible engine for collecting customer data.
Which feeds back into product development.
Precisely. They get direct insights into what people are buying, what they're browsing, what combinations work. That data fuels their innovation pipeline in a way that brands selling primarily through third parties just can't replicate as effectively.
Okay, so DTC gives them control and data. Let's talk about the product itself. That's pillar number 2, right? The famous science of feel. Is that just clever marketing or is there substance there?
Oh, there's definitely substance. It's arguably their core technical advantage. This isn't just about picking nice fabrics off the shelf. They invest heavily in proprietary textile engineering.
Like specific fabrics they own.
Exactly. Think Luon, Nulu,
Okay.
Lux. These aren't generic names. They represent specific fabric constructions, specific polymer blends that Lululemon has developed and often patented. They're designed to provide a distinct sensation, how it feels against the skin, how it wicks moisture, how it stretches, how it holds its shape wash after wash.
So if a competitor wanted to copy that, say, Nulu fabric, feel the one they market as feeling like you're wearing nothing.
They couldn't just easily replicate it. They'd have to try and reverse engineer the specific material science, the manufacturing processes. Lululemon has built a real technical barrier there. And that's what allows them to credibly charge, nearly $100, sometimes more, for a pair of leggings.
Because the customer perceives, and arguably receives, a genuinely different, better feeling, longer lasting product.
That's the idea. It justifies the premium price and defends against the race to the bottom on price that you see in a lot of apparel.
Okay, premium product, premium price, controlled distribution. Now, how do they market this stuff? Because they don't seem to do the huge Super Bowl ads or massive celebrity endorsement deals like Nike or Adidas.
No, and that's the third pillar, their community-based marketing.
Yeah.
It's kind of a grassroots approach, and it's remarkably efficient.
The ambassador network. Yeah.
Exactly. Instead of paying, say, LeBron James millions, they invest in local fitness leaders, yoga instructors, run club organizers, personal trainers in specific towns and cities. These people are already influential in their communities.
And they're presumably using and loving the product authentically.
That's the key. They become genuine advocates. They wear the gear while teaching classes or leading runs. They host events in stores. It builds loyalty from the ground up in a very authentic way.
And the financial impact of not spending like the big guys, it's huge. Lululemon's selling, general, and administrative expenses, which include marketing, typically run less than 5% of their revenue.
Less than 5%. Wow.
Yeah. Compared to
Nike or Adidas, who are often spending somewhere in the 9%, 11% range on marketing and endorsements. So Lululemon gets massive brand awareness and loyalty while saving, 4, 5, even 6 percentage points of revenue compared to peers.
And that saving drops straight to the bottom line, boosting their operating margin.
Precisely. It's a highly capital-efficient way to build a premium brand. So you put it all together, unique product feel, direct customer relationship and pricing control, and super efficient marketing. That's the Lululemon moat.
It sounds like a perfect business model, which makes the current slowdown even more puzzling. So let's zoom out. What's happening in the broader athleisure market?
Well, the overall trend is still strong. Athleisure isn't going away. It's driven by fundamental shifts that focus on health and wellness, people wanting comfortable clothes for hybrid work, casualization of fashion. It's all still happening.
And the market size reflects that, right? It's enormous and still growing globally.
Absolutely massive. We're talking hundreds of billions globally. It was estimated around, $358 billion in 2023. And projections show it growing strong, maybe hitting over $660 billion by 2030. So there's definitely room to grow in the overall market.
But the competitive dynamics within that market seem to be shifting, especially for Lululemon.
They are. For years, Lululemon was the cool disruptor, stealing share from incumbents like Nike, particularly in women's premium apparel. Nike's still the giant overall in U.S. sports apparel, holding maybe 31–32% of monthly athleisure spend. Lululemon is a very strong number 2, around 21%.
But now Lululemon isn't the disruptor anymore. In the premium space, they're the incumbent.
Exactly. And now they're the ones facing disruption from a new wave of competitors.
Who we're talking about specifically?
Mostly digitally native, direct-to-consumer brands that have sprung up, often heavily venture capital funded. Think Vori, think Alo Yoga. Beyond Yoga is another one. They've kind of taken the Lululemon playbook, but maybe adapted it faster for today's social media landscape.
And are these brands actually making a dent? Or is it just noise?
It looks like more than noise.
Yeah.
Anecdotally, and you see this in some fashion commentary, brands like Vori and Alo are increasingly seen as, cooler or more on trend, particularly with younger demographics or certain influential circles.
So potential relevance issue for Lululemon.
Potentially, yes.
Yeah.
And Vori, for example, has shown some pretty rapid growth. I think there were reports of their sales jumping over 20% through late 2024.
Okay, so even if their individual market shares are still relatively small compared to Lululemon,
Right. Vori might be around 3%. All maybe just over 1%.
their collective rise is fragmenting that premium market that Lululemon used to dominate almost single-handedly.
That's the key point. The premium space is getting more crowded. Lululemon now has to fight harder to maintain its share of wallet against these nimble, often trendier competitors.
So going back to the moat, does it still hold up against these new challengers?
Well, the argument is that Lululemon's scale is still a massive advantage. Replicating that science of feel fabric tech isn't easy. And crucially, building out a global network of over 780 profitable stores plus a huge e-commerce operation, that takes enormous time and capital that these newer brands don't have yet.
But couldn't that physical store network become a liability if trends shift really fast, all that expensive real estate?
That's the flip side. It's a double-edged sword. Right now, the stores are profitable brand hubs. But if U.S. store traffic and sales keep declining like they have been recently, well, then that huge footprint starts looking less like a moat and potentially more like an anchor. It's a risk.
Okay, that's a perfect transition. Let's talk hard numbers, the financial picture. Because even with slowing growth, Lululemon's profitability is still pretty remarkable, isn't it?
Oh, it's exceptional. It's the standout feature. Forget the growth for a second. Their margins are genuinely best in class across the entire apparel sector, not just athleisure.
Let's start with gross margin. That's revenue minus the direct cost of making the goods. Lululemon consistently hits near 60%.
Yeah, LTM gross margin was 59.1%. Think about that. For every dollar of clothing they sell, almost 60 cents is gross profit before overheads. In apparel retail, hitting the high 40s or low 50s is considered really good. 60% is phenomenal.
And how do they do that?
It comes back to the moat. It's the direct result of that DTC model, no wholesale discounts combined with strong brand pricing power, underpinned by that perceived product differentiation from the science of feel. People are willing to pay full price.
Okay, gross margin is stellar. What about operating margin? That includes all the overheads like marketing, rent, salaries.
Even more impressive, in a way. Lululemon's LTM operating margin is around 22.88%, almost 23 cents of operating profit for every dollar of sales.
How does that compare to the giants Nike and Adidas?
It blows them away. Nike's operating margin recently has been closer to maybe 7.9%. Adidas even lower, around 5.6%.
Wait, so Lululemon is generating 3 to 4 times the operating profit per dollar of sales compared to Nike and Adidas?
Essentially, yes. It just highlights how much more structurally profitable their vertically integrated, high-price, efficient marketing model is. They keep way more profit from each sale after running the entire business. That profitability is their financial cushion.
And that efficiency must translate into great returns for investors.
Absolutely. Their return on equity, ROE, has been really high, recently around 42%. They're very effective at generating profit from the capital invested in the business.
And all this profitability fuels a very strong balance sheet, right? You mentioned cash earlier.
A fortress balance sheet. They ended fiscal 2024 with about $2 billion in cash and equivalents. And here's the kicker. 0 long-term debt.
0 debt for a company this size is almost unheard of. Is that always a good thing? Does it maybe suggest they're too conservative? Could they use debt for acquisitions, maybe buy one of these cooler, smaller brands?
That's a fair debate. Some analysts argue they should use their pristine balance sheet more aggressively, perhaps for M&A to quickly grab market share or inject newness. But management seems very focused on financial flexibility and funding growth organically.
And they generate a lot of cash internally anyway.
Oh yeah, they're a cash-generating machine. Over $1.1 billion in free cash flow in the last 12 months. So they can fund store openings, tech investments, and share buybacks without needing to borrow.
Okay, that financial strength is the bedrock. But now they need to reignite growth. Let's talk about their big strategic plan. The power of 3 times 2 sounds ambitious.
It is ambitious. Announced back in 2022, the goal was to hit $12.5 billion in revenue by 2026. Given where things are now, especially the U.S. slowdown, hitting that number looks, well, challenging. It relies heavily on executing 3 key growth pillars.
Okay, pillar 1, double the men's business. We know it grew 14% recently. How do you double it from here?
A key part is expanding beyond just apparel. The big move was launching their first men's footwear collection in early 2024. It's about becoming a head-to-toe brand for men, not just the go-to for great pants. Expanding the product categories is crucial.
Pillar 2, double the digital business. E-commerce is already huge at nearly 40% of sales.
Right, so doubling it means getting digital penetration potentially closer to 50%. This is vital not just for sales, but because, as we said, it's a high-margin channel and the source of that invaluable customer data that fuels innovation and personalization. It has to keep growing faster than stores.
Okay, men's and digital. But the real pressure, especially now, seems to be on Pillar 3, quadruple the international business.
Absolutely. This has become the make or break pillar, with the Americas market actually shrinking in recent comps. Almost all the company's net growth has to come from outside North America. International has to carry the load.
Where are they seeing success internationally?
The growth rates have been spectacular, particularly in Asia. China mainland revenues surged 41% in fiscal 2024. The rest of world segment grew 27%. And that momentum seemed to continue into Q2 2025, with overall international revenue up 22%.
41% in China. That's massive. How are they achieving that? Just opening stores?
Targeted store openings are key, yes. Like their first store in Italy just opened in mid-2025. But it's also about adapting the digital strategy for platforms like Tmall and WeChat, localizing marketing, and ensuring the product resonates culturally.
But quadrupling a business internationally sounds incredibly complex. What are the big risks there, especially in a market like China?
The risks are significant. You've got geopolitical tensions, potential economic slowdowns, intense local competition, navigating completely different digital ecosystems, ensuring the brand message translates. It's just inherently harder and less predictable than operating in your home market.
So the original plan probably assumed North America would keep chugging along with maybe low to mid single-digit growth?
You'd assume so, yes. That was likely the baseline. Now, with North America going backward, international doesn't just have to perform well. It has to massively overperform just to keep the overall company growth positive and anywhere near the original $12.5 billion target.
Which significantly raises the overall execution risk for the whole company.
Dramatically. Much more weight is riding on these less mature, potentially more volatile international markets. A stumble there has much bigger consequences now.
Okay, this brings us squarely to the immediate problems, the red flags that have spooked the market and hammered the stock. Let's start with that U.S. slowdown. It seems worse than just a temporary dip.
It really does feel more structural.
Yeah.
America's comparable sales tracking sales in established stores were down 1% in fiscal 2024. Worrying. But then they fell 4% in Q2 2025. Negative 4% comp in your core, most profitable market. That's a serious issue.
And management isn't just blaming the economy, are they? Didn't the CEO mention product execution?
Yes. CEO Calvin McDonald was pretty candid. He said they were, quote, disappointed with our U.S. business results and aspects of our product execution. That's telling. When a CEO points to product execution, it often means they missed on style, color, assortment. Something internal wasn't resonating with customers.
Which lends credibility to the idea that those newer, maybe cooler competitors are impacting Lululemon's appeal.
It certainly suggests it's not just external factors. It implies a potential relevance problem, at least temporarily, in their home market.
Okay, so stalled U.S. growth, potential product misses. What's the second major red flag? The inventory situation.
Yes, this is the one that often precedes margin trouble. It's the inventory overhang. Look at the numbers at the end of Q2 2025. Inventory was up 21% year over year.
21% increase in stuff sitting in warehouses and stores. But overall, revenue only grew.
Only grew 7% in that same period.
Oof. Inventory growing 3 times faster than sales. That's not good.
It's a classic warning sign in retail. It means they have way too much product relative to current demand. That product isn't selling through as fast as they planned.
And the consequence of that pileup?
Huge pressure on gross margins down the line. All that inventory is cash tied up on shelves. Eventually, you have to clear it. And for a brand like Lululemon, whose entire premium image is built on not having big sales,
It forces a really tough choice. Either let the inventory get old and risk obsolescence, or break the full price strategy and start discounting heavily.
exactly. And heavy discounting can seriously damage that premium brand perception they've worked so hard to build. It risks eroding the very thing that justifies the high margins.
So it's a potential downward spiral. Slow sales lead to high inventory, which forces discounts, which hurts the brand, which could hurt future sales.
That's the nightmare scenario they need to avoid. And recognizing this pressure, they made a significant move recently, didn't they? Appointing a chief AI and technology officer.
Right. Ranju Das, appointed in August 2025. That seems like a direct response to these inventory and demand forecasting issues.
It absolutely signals a focus on using data and AI much more effectively. Not just for customer-facing stuff, but critically for optimizing the supply chain, managing inventory better across their global network, and trying to predict demand shifts more accurately to avoid getting caught with so much excess product again.
Trying to get smarter and faster to compete with those nimbler DTC players.
Essentially, yes. Using technology to manage the complexity that comes with their scale.
Okay, so U.S. slowdown, inventory bloat, increased reliance on risky international growth. It's no wonder this has led to a major reassessment of the company's value. Let's talk about the valuation reset.
Yeah, the market reaction has been severe. Historically, Lululemon commanded a really high price-to-earnings multiple. Its median PE was often up around 41x, sometimes higher.
Because investors are paying for that reliable 25% plus growth.
Precisely. It was valued like a high-growth tech stock, almost. But after that Q2 2025 guidance cut, forecasting only 2–4% growth, the market completely recalibrated.
What happened to the PE ratio?
It plummeted. At points, it fell down near 14x earnings, which is way down at the bottom end of its historical range. A massive compression of the multiple.
And how does that compare to Nike and Adidas now? Because Lululemon is still way more profitable.
That's what's so striking. As of late 2025 data, Lululemon's trailing PE was down around 12x. Meanwhile, Nike, with its much lower margins, was trading around 33x PE and Adidas around 27x.
Hang on, let me get this straight. Lululemon, with triple the operating margin and no debt, is trading at less than half the earnings multiple of Nike and Adidas.
Correct. That massive gap highlights the core debate perfectly.
So what's the market saying? What's the bear case justification for that low multiple?
The bear case is essentially that the market has lost faith in Lululemon's ability to reignite significant growth. It's pricing LULU like a mature, slow-growing apparel retailer that's hit saturation in North America. The bears believe the high profitability, while nice, isn't scalable globally in the same way, and the international growth story is too risky or won't be enough to offset the domestic slowdown.
So the market thinks the best days are behind it, growth-wise. What's the bull case? Why might 12x earnings be a bargain?
The bull case argues that this is a massive overreaction. They'd say the U.S. slowdown is temporary, maybe a fashion cycle miss that's correctable, or just a short-term consumer pullback. They believe the international growth engine, especially in China, is durable and has huge runway. If Lululemon can execute internationally and stabilize the U.S., they could re-accelerate overall growth back into the double digits eventually.
Making the current 12x PE look ridiculously cheap in hindsight.
That's the bull argument. They see incredible profitability, a strong balance sheet, and a powerful global brand currently being priced for near zero growth, which they believe is too pessimistic.
So it really boils down to whether you believe management can navigate this international pivot perfectly while fixing the issues at home.
That's the crux of it. Bulls bet on execution and brand resilience. Bears bet on saturation and the difficulty of scaling that premium model globally under pressure.
This has been incredibly helpful in mapping out the situation. We've covered a ton of ground. Let's try and summarize the key takeaways.
Okay. On the plus side, you have Lululemon's truly exceptional profitability. Those near 60% gross margins are incredible, backed by a rock-solid debt-free balance sheet with billions in cash. That financial strength provides resilience.
But the big but, the growth engine, has clearly stalled in its core, highly profitable North American market. We saw that with the negative 4% comp in the U.S. This means the company is now hugely dependent on executing flawlessly in international markets.
Markets like China, which are growing fast, yes, but are also inherently more complex and perhaps riskier to operate in.
In management's response to this, their capital allocation seems focused on reinvesting heavily in growth technology like AI, international store expansion, and also buying back a lot of their own stock. They bought back $1.6 billion worth in fiscal 2024.
Right. They're using share buybacks aggressively, which supports the stock price and signals management believes it's undervalued. But they're choosing that over, say, starting to pay a dividend, which some mature retailers do.
So for you, the listener trying to track this situation, what's the single most important metric or red flag to watch right now?
For me, it's got to be that spread we discussed. Inventory growth versus revenue growth. Right now, inventory is up 21%, revenue up only 7%. That gap is unsustainable for a premium brand.
Because if that gap doesn't close.
If it persists, they face that brutal choice. Damage margins by holding on to aging inventory, or damage the brand's premium perception by resorting to widespread sales and promotions to clear it out. Watching how they manage that inventory level relative to sales in the coming quarters is crucial.
Which leads perfectly into our final provocative thought for you to chew on. The real magic of Lululemon, the source of its value, has always been that intangible brand equity, that aspirational status, the cool factor. Can a brand truly maintain that elite, premium identity, the very thing that justifies $100 leggings and 60% margins, if it finds itself increasingly forced to use promotions and markdowns just to move product off the shelves?
That's the fundamental tension. Can premium perception coexist with promotional necessity? History suggests it's incredibly